You're playing not just the earnings, but your option strategy actually goes out to January expiration. So you're actually pretty optimistic about this stock.
Yeah, I'm reasonably optimistic about the stock, but I don't think the stock moves in straight lines. So I understand the inherent volatility that is associated with any of the Chinese internet stocks. I mean, we saw earnings from Soho today, and they were less than optimal. If you like, the guidance wasn't as good. As a result, all the Chinese internet stocks are selling off a little bit, including Baidu. But I believe that the strategy that the company has adopted, which is its laser focus on mobile, I think it's the right strategy. They currently only have 10% of their revenue coming from mobile, and the general expectation is that that percentage is going to increase over a period of time, and the management has really put that as their top priority.
And you see upside, you see a good amount of upside in the stock because you're looking for it to go to a maximum. I mean, you get your maximum profit when it gets to what, $200 a share.
That is correct.
Which would be almost $50 higher than where it is now.
Right, 30%. So let's quickly recap the trade, if I may. So what I want to do for this bullish stance in Baidu is I want to buy the January 170, 200 call spread, i.e. I buy the January 170 strike call, and I simultaneously sell the January 200 strike call. This call spread cost me around $6, and what I want to do further to cheapen the price of this call spread is want to sell the January expiration 110 strike put for about $1.50.
To finance the trade, essentially.
That is correct. So effectively, I reduce the cost of my call spread by a third by selling that put. Now remember, the reason I choose 110 strike put that I'm selling is because that's where the stock was trading before the last earnings. And so if I were to get to that level, then I would be comfortable owning the stock at pre-Q2 earnings level, which is a 30% discount to where the stock is trading right now. Now, in terms of my upside, what happens if the stock starts to rally? Yes, the stock needs to do a little bit of work. The stock needs to rally about 10% for me to start making money, 10.5% call it, in order for me to start making money. But I believe that the stock can do that. Remember, the earnings options are implying, the short-term options, the weekly options are implying around 8% move because the straddle at the money straddle is worth around 10%. So I stand to make money if the stock does decide to move upwards around 8-9%, which is what the implied move is. And once I get to that point, then I will be adjusting the trade slightly in order to either keep the profit or reduce the downside risk that I have by additionally selling the 110 strike put.
Now, as you mentioned, the company is very focused on mobile, just as a Google, just as a Facebook is here in the U.S., and monetizing that part of the business. The biggest risk would likely be, say, competition. Qihoo is getting more into, which is another Chinese company, is getting more into search, has taken a little bit of Baidu's market share, although it's still really dominant. But how much of a risk do you think that is for this earnings report and then going forward?
So Qihoo is basically focusing more on desktop search, and Baidu has a dominant share in desktop, but Qihoo is not really as much focusing on mobile, whereas Baidu is now focused on mobile. So yes, there is a little bit of risk, but Baidu has also done some acquisitions. We mentioned, Emily Cheng mentioned earlier in the segment. All those acquisitions are just basically meant to consolidate its position.